In this video, we're going to walk through the calculation of various cost of goods sold items. Axion uses a periodic inventory system. During the most recent year, Axion reported $600,000 in sales. For each of the following independent cases, find the missing items and calculate Axion's gross profit as well as gross profit margin. In our first case, we're going to calculate goods available for sale. We've got beginning inventory of $70,000 and we've made purchases of $200,000. That gives us $270,000 worth of merchandise available for sale. If we have $50,000 left over, that means we sold $220,000. That's the $270 minus $50,000. Our gross profit margin, of course, is sales of $600,000 minus $220,000 for cost of goods sold, or $380,000 for our gross profit. We can take that gross profit of $380,000 and divide it by $600,000 in sales to get our gross profit margin. So we're making roughly 63 cents in profit for every dollar in sales. Of course, that's before our other operating expenses. Scenario 2, we're told the beginning inventory is $70,000 and we've got goods available for $320,000. So that means during the year we must have purchased an additional $250,000 worth of merchandise. Now, if we've got $320,000 available for sale and 50 is left over at the end, that means $320,000 minus 50, or $270,000, is our cost of goods sold. We subtract the cost of goods sold from sales and get a gross profit of $330,000. We can then take that $330,000 and divide it by $600,000 in sales to get our gross profit margin of 55%. Again, this means that we're making 55 cents in profit on average for every dollar in sales revenue. Again, of course, that's before our other operating costs, advertising, salaries, rent, utilities, taxes, interest, etc. Scenario 3, we're told beginning inventory is $70,000 and during the period we purchased $300,000. That means, of course, we've got $370,000 available for sale. From that $370,000, we either sell it or it's left over. We're told that we sold $300,000. That means $70,000 must be left over in ending inventory. So again, we can calculate ending inventory as from our goods available of $370 minus our cost of goods sold. Sales minus cost of goods sold gives us our gross profit of $300,000, and $300,000 divided by $600,000 in sales means we have a gross profit margin of 50%. The next scenario, we need to approach this one slightly differently. The first thing that we're going to want to calculate is our cost of goods sold. We're given sales of $600,000 and our gross profit of $260,000. The difference between the two has to be our cost of goods sold. Then, of course, if cost of goods sold is $340,000 and we've got $60,000 left in ending inventory, that means we must have had $400,000 available for sale. That's again simply the cost of goods sold plus our ending inventory. Now, if we started the period with $70,000 and we had $400,000 available for sale, that means the difference between the two, or $330,000, is what we purchased. Our gross profit margin, of course, is simply our sales, or rather our gross profit of $260,000 divided by sales of $600,000. The last scenario, our starting point is going to be making use of our sales of $600,000 and our gross profit margin of 30%. Again, recall, our gross profit margin means how much profit we're making for every dollar in sales. And in this case, we're making 30 cents in profit for every dollar we have in sales. So if we have $600,000 in sales, 600,000 times 30% means our gross profit had to be $180,000. Then, of course, to calculate cost of goods sold, that's simply the difference between sales and our gross profit. So 600,000 minus 180 gives us our cost of goods sold of $420,000. So if we sold $420,000 of merchandise, had 70 left over, that means we had to have had $490,000 available. And if we made purchases of $440 and we had $490 available, our beginning inventory had to be $50,000.